Hi there, this is Brad Levin, CEO of Legacy Wealth Partners. Thank you for taking the time to join me. It's February 9, 2018. I want to spend a few brief minutes talking about the current market correction that we're in the midst of, the cause behind this, and share with you our perspective on how we think you can best navigate this. Over the last 2 weeks, we've seen the stock market reach all-time highs for both the Dow and the S&P 500, and since then they've sold off dramatically, bringing the indices down 11% from their all-time highs as of today. This puts us now officially in correction territory. In fact, this week alone, the Dow Jones Index dropped more than 1,000 points on 2 separate days. Investors are now naturally starting to get nervous and question whether this could turn into something more serious or if this correction is going to easily and quickly get resolved. First, I want to give you some historical context before I talk about the causes. We've experienced an abnormally long level of low volatility in the markets. In fact, we went 271 days without the markets experiencing even a 3% correction. That has never happened in history. When investor confidence reaches the level that it did, an extreme, it doesn't take a lot to trigger a negative reaction in the markets and cause investors to start hitting the sell buttons. And that catalyst came last week. The January jobs report showed that we created 200,000 new jobs in the month. And over the last 12 months, wages have increased 2.9% overall. That's really good news, especially welcome to many Americans who've seen static wages for a lot of years. Why did the market take that news as a negative? Unfortunately, in the financial world, too much good news actually is bad news because it means that the economy could be overheating, creating inflationary pressure that would cause the Federal Reserve to raise interest rates more aggressively than thought. However, we've not seen salient signs of inflation, just this one data point related to wage growth. That was enough news, though, for bond investors to start dumping bonds because rising interest rates is a negative factor for the price of bonds. Bond prices drop when interest rates go higher. Also, for the stock market, the news of higher interest rates meant that the cost of capital for both consumers and corporations could be on the rise, and that could eat into corporate profits and also consumer spending. That was the catalyst for both bond market and the stock market to begin a contraction. Now, I want to give this some historical context for you in terms of the bond market because yields on the 10-year Treasury bond, which is the benchmark for the bond market, were hovering around 2.4% for all of last year and began this year at also the same point, about 2.4%. We were at 2.5% by the middle of January, but over the last 2 weeks reached 2.85%. That movement in the bond market was just too much for investors to be able to stomach. As I said, we've not seen salient signs of inflation yet, but investors are already reacting, in fact, doing the Federal Reserve's job for them. I want to talk about this, though, in terms of past corrections to give you some perspective on where we might sit today relative to those corrections and what might happen from here. From 1980 until now, we've had 38 market years, and of those years, 29 of them have turned out positive at the end of the year in terms of returns. However, intra-year, the average decline was 13.8%. That's the average pullback in the course of any stock market year over the last 38 years. And yet 29 of those years ended up with positive returns. We take a look at this in terms of bear markets or those corrections that turn out to be a decline of 20% or more. What is the possibility that this stock market correction could turn into one of those? Well, we've had 10 bear markets since 1928. And of those 10 bear markets, 8 of them coincided with a recession. Only 2 bear markets occurred when we didn't have a recession. So the odds tell us that if we have a recession, that's what's going to cause the end of the bull market. When we look at those 2 bear markets, though, that occurred when we didn't have a recession, they occurred because the valuations on stocks were very high. And yet those 2 bear markets turned out to be the shortest-lived bear markets in history. Today, we've had very high valuations in the stock market, and many experts have been saying that this would bring about the correction in the market that we have now started to experience. But history tells us that this kind of environment that we're in right now is more likely to resolve itself shortly after where we are today, and probably we'll experience a sharp rebound in the market because the fundamentals of the U.S. economy are not indicative of a recession at all today. In fact, quite the opposite. The fundamentals of the U.S. economy are quite strong. Unemployment is very low, and we're also in the midst of an earnings season right now that is on track to turn out to be one of the best that we've seen in many years. Around the world, the growth is even better than the United States. So from many perspectives, we could say that this is actually a very ideal environment for market investors. At this point, what we can tell you is that this is a sentiment-driven sell-off that will most likely resolve itself pretty soon. Our best guidance for our clients is to consider the fact that we've designed a personalized investment strategy for you, aligned with your return expectations and tolerance for risk, focusing on your long-term needs and goals. My advice is to stay the course and follow the plan that we've laid out together, because that plan takes into account the expectations that we will experience volatility like this. But it's also important to understand, and for me to communicate to you, that staying the course doesn't mean that we continue to do the same thing day after day and month after month with no changes. We will adapt your portfolio in response to the market's movements as well as developments in the economy. However, we're not going to do that letting our gut feelings drive the changes we make in your portfolio. We utilize data that compiles for us information about the health of the economy as well as the trend in the stock market to come together to act as the weight of the evidence that will guide our decisions. My advice is to trust in the plan that we've put together and then utilize that to give you confidence that over the long term, you're going to be okay. In fact, in retrospect, we may be able to look back on the environment that we're in now and see it as a great buying opportunity. Thank you for taking the time to be with me today. We are always here for you and willing to answer questions and looking forward to talking to you soon.